Hello and welcome to the first investment review of 2015. As I mentioned in the last review that I wrote toward the end of 2014, I thought that it was probably more meaningful to reduce the number of investment reviews so as to make them more reflective of fresh events in markets and to give a broader view of the next few months ahead. Thinking about 2014, it is perhaps relevant to begin this review by giving consideration to what the broader markets did in 2014. The index that most people are familiar with is the FTSE 100, this reflecting the weighted average value of the top 100 shares in the UK. Over the 12-month period, this market was actually flat. It also demonstrated significant volatility, which is something that most of our clients are not generally happy with. There are, of course, some major news events this year that are standing in the background, and these include the forthcoming general election, the issues that surround Greece and their significant national debt, the political friction between Russia and the West, and the continuing pressure on oil prices. For investors, other issues that are of significant importance include the outlook for interest rates. Despite the Bank of England repeatedly warning of inflationary pressure, inflation will probably turn negative, and this has moved the prospect of an interest rate rise much further away. What this means for investors is that to get a real return on money, an investment risk has to be taken. It is fair to say that since the banking crisis of 2008, it has been impossible to find a truly zero-risk environment for the investor. It is almost as if the rules of old have changed, and we need to have a fresh focus on how our assets can best work for us. So how will 2015 shape up? The start to 2015 has been volatile, although, as has widely been reported, it's also been very positive, with international stock markets reaching 15-year highs. This may seem peculiar given the geopolitical and economic risks earlier mentioned. What has definitely impacted positively upon European markets is the eventual decision made by the European Central Bank to increase quantitative easing and inject new capital into markets. Typically, whenever this happens, markets rise, rejoicing somewhat in ultra-low-cost funding from government. This news was preceded by the Swiss removing the forced peg that their franc had to the euro, which instantly made everything in Switzerland much more expensive, but once the news formalised, it resulted in a significant weakening of the euro, which in itself was not a surprise. Mentioning now our typical investment portfolio, when we reflect upon the performance of an average portfolio that we construct, and looking at this across 2014, the chart on the next slide shows the performance of the fund blend that has been achieved. We blend a mix of funds, some higher risk and some lower risk, in order that we can obtain greater diversification across geographical asset classes. It won't come as a huge surprise that most clients fall somewhere in the middle of the risk scoring system that we have discussed during the investment decision-making process. That's why I've included the chart on the next page. You can see that whilst the FTSE 100 has been volatile and flat, the medium risk portfolio that we would commonly use has returned something north of 8% over that 12-month period. In the same time, cash would have returned around 1%. It's really hard to say what the outlook for 2015 is. Looking through this year, we are positive about the probable outcome, but we don't think that it will be without volatility, particularly in the headline markets. What is noteworthy is reflecting upon how this review opened with a look at one headline market, the FTSE 100, and seeing that its performance over 2014 was flat, whereas the mid-risk portfolio we have used performed rather more pleasingly. Therefore, it's always worth noting that newsworthy items are not necessarily reflective of what is happening on a day-to-day basis with a properly diversified investment portfolio. I'm turning now to areas that we're keeping an eye on. There are two areas offering some concerns. The first is the corporate bond sector. This has been significantly bought into by probably first-time investors who are looking for what is regarded traditionally as a low-risk investment. These bonds have a yield reflective of the interest rate that the bond pays, but in addition, demand has been so significant in recent years, the capital values are appreciated against a background of limited supply. This is also true of UK gilts. Therefore, it is widely believed that there is a potential bubble with these investment classes. That said, this noise has been in the markets now for around 18 months, and as mentioned earlier, is only likely to be problematic in the event of a significant rise in interest rates, which currently looks unlikely. The Bank of England has apparently made an unashamed U-turn on the interest rate outlook, and so the outlook for gilt and corporate bonds remains relatively stable in the short to medium term, and therefore we're not suggesting any immediate changes, but we are watchful of this area. The other area that has been disappointing is natural resources, and in particular the Natural Resources Fund that we have used. The fund has failed to perform in accordance with our expectations. The fund itself, however, is very capable of performing strongly when market attention turns toward the natural resources sector. If analysed from the end of January, it has actually grown by over 6%. It stands to reason that you don't need too many periods like that, and the uncomfortable loss position can be quickly reversed. Also, we do need to bear in mind that when we undertake financial planning, not all of the investment funds will operate in the same way at the same time. This volatility and occasional downturn is a natural function of investing, particularly in the higher risk-rated funds, such as the Natural Resources Fund. Where there is no immediate need for capital, I'm unwilling to recommend to any of our clients, particularly bearing in mind the aforementioned capability of this fund to perform better, that we crystallise losses by undertaking a fund switch now. Doubling up a bet on another fund smacks more of gambling than considered long-term strategic investment planning. That said, I'm mindful of the losses, and we do need to keep an eye on this area, and given that we all use this investment fund, it is very closely watched. In the context of one of our investment reviews, the headline here looks quite dramatic. Changes in pension legislation take effect from this April. To say that these are significant would be a huge understatement. We believe that this redesigns the way that financial advice needs to be imparted, and as a consequence of this, it will be necessary for us to revisit in many circumstances how financial advice is positioned for our clients. We therefore anticipate a very busy period ahead, dovetailing the new legislation to suit our clients' individual circumstances. Please do contact us if this concerns you, but also please rest assured that we will be in touch should we regard it as relevant to your circumstances. So this summary is to close the investment review, bringing the review to an end. There are some significant challenges for markets ahead, but we believe that the diversified portfolio that we are holding for our clients still continues to be appropriate. We monitor this extremely closely, monitoring against many benchmarks. By this I mean we compare the returns for our clients against typical cash returns, against various stock markets, and also against various external management systems. We are pleased with the latest series of returns that clients are now starting to see as the investment portfolios bed into a more stable market. We should not, however, be surprised by sudden bouts of volatility, although at the same time, we should not necessarily panic about them either. The office contact details follow on the next slide as usual, and of course you're welcome to contact us at any time should you wish to discuss any matter any further. Thank you for listening.